Hi, this is Stephen from Share Navigator back again with our historical research of stocks. And again, we're using Alaska Airlines as an example. And now we're going to look at net income growth, which is basically another word for profit growth. And we're also going to look at earnings or profit per share. So, very simply, profit per share is simply the total profit of a company divided by the amount of shares on issue. And that's where you get the profit per share number. So we're going to show you first of all where to go and get that data, and then we're going to analyze it for you. So again, back to Alaska Airlines, we're going to look at the income statement. And if we scroll down the income statement, you're going to go through all the costs that are taken out of the business here. And eventually you're going to get to a net income figure here. So you can see net income, and then underneath it, it has year on year growth. And we're going back again. You can see this defaults to the quarterly numbers. We want to change that to annual. Okay, we're on the free version here at the moment, but we also have a paid version, or Share Navigator do. So we'll take in this data here. If you wanted that data, you're going to have to subscribe. But 5 days years of data is enough if you want. We will come down, and you can see here it's telling you what the net income growth is, and then the growth rate underneath it. So again, 2020, this might spook you, the fact that the company lost $1.3 billion. But you know what? That was COVID, and for obvious reasons. 2021 slightly better, back to an increase, 478 million. And then the net income dropped again to 58 million. So you'd be asking the question there, what happened here? Increased again to 235 million, and so on and so forth. So we're going to analyze all this data. And then if you scroll down a bit further in the income statement, and I'll show you another way of getting this data, you can see there's two ones here: basic earnings per share and then diluted earnings per share. So the difference between the two, diluted earnings per share accounts for the exercise of stock options. And you can choose either figure. Once you're choosing both, so for comparison purposes, and again, we're just going to cut and paste this data and bring it back into our PowerPoint presentation. So we went back as far as 2017. Now, in our previous video, the sales growth got a big tick. This is not going to get a tick here. So straight away, I'm looking at 2017. The company made a profit of just under $1 billion. Okay. And the growth rate that year was 18%, which was great. Big drop off then into 2018. You'd want to find out what happened in that year, because that had nothing to do with COVID. Obviously, the 2020 sell off or drop off in profitability is very easily explained because of COVID. The pickup then again into 2021, and you'd want to be asking questions then again of what happened in 2022. And then underneath that, we have the earnings per share data. So we can see here that the profitability kind of went from 960, and now we're kind of in 2023. We know the sales grew in that period of time, but the profitability is down. So there's something not right there, and you have to investigate what that is. Think about it. If the sales have grown on average by 6% a year or 5% a year, but look at the profits, they've actually dropped by 600 million here. So the company's grown its sales, but the profits have reduced. That usually isn't good, but there might be some reasonable explanations for it. And there is in this case, and we'll explain why in a second. And it's similar with the earnings per share. Now, the reason we're looking at the earnings per share here, we're looking to see if the numbers here are fairly similar. The reason for that is, remember what earnings per share are. Earnings per share is simply the net profit of a company divided by the amount of shares on issue to get the profit on a per share basis. Now, sometimes companies use a thing called financial engineering in order to grow their earnings per share. So if you think about it, if earnings per share is the net profit divided by the amount of shares outstanding, if a company goes and buys back its own shares, which is called a share buyback scheme, they're reducing the number of shares outstanding. Their profits mightn't have increased, but actually their earnings per share could increase if they just reduced the number of shares outstanding. That's a positive for investors. However, it's the least positive outcome for profit growth. Really, what you want to see with a company is their sales growing. That's the first. If you were to look at a hierarchy of profit growth, You want to see it through kind of demand for their products and services, number one. Number two is cost cutting, and number three is share buybacks. They're all positive for investors. But if a company can only grow its earnings per share by actually reducing the amount of shares outstanding, that's not really sustainable in the longer term. And it mightn't be worth investing into that particular company. You would have to assess it on its merits at that time. But right now, what I'm looking at here is a picture that isn't great. Okay, I'm not liking the fact that the sales grew, but the profits declined, and I need to know why and what happened. So that's my first thing that I had to go and do a bit of research. So that's what I've explained here. Um, there's no real evidence of share dilution either, because the earnings per share has really kind of decreased at the same rate as the net income here. Um, so what I did was you just simply go to Google or you go to the company report. So every publicly quoted company by law must have an investor relations part of their website. And that's where you can actually go and find out, is there something going on with the company that we need to know about? So, in the last number of years, the company has been incurring exceptional costs. And I'm going to show you where you kind of can pick that up when we go through the income statement for impairment charges related to fleet changes. Okay. So, it's not just that their costs mounted, these are what we call exceptional items. So, they're happening for the next couple of years as they change their fleet, but they're not going to continue indefinitely going forward. So it's not like they've, doubled their workforce or anything like that. This is stuff that's really, they're switching out planes, and there's impairment charges for that. They're not going to continue to happen on an ongoing basis going forward. So they're spreading that out over a number of years. So let me show you, let's go back to the income statement and show you where you can pick that up. So we'll just go into Alaska Airlines again. I'm just going to bring you into the financial statement here. We're going to go to the income statement again, annual. So if you're looking through here, so now I'd be going with that. Well, where has the costs come out? We know in the income statement the costs are mentioned up above here. And we look from year to year, well, where did the costs actually start amounting? You've got non-operating income, you've got pre-tax income, you've got taxes, etc., like that. So where did the cost come? Was it operating expenses? Was there massive increases in that? And I'm kind of looking here. Okay, you know what? 313 million in 2019 up to 3. It's actually down in 2023. So it's not SG&A here. Then you look at other operating expenses and you go, okay, there's a bit of an increase here. So you'd find out what was going on there as well. So you'd have a quick look in there. But also you kind of go non-operating income. And this is where you're kind of going to see some of the big jumps. Interest expense, you can see here is pretty normal. And then we come down to unusual income and unusual expenses. And you can see it's gone from 38 million and it's jumped up to 459 million. Obviously, through COVID, it went through the roof, 2021, 2022. But it's reducing. You can see that this is reducing. So this is what they have a heading in here, unusual income and expenses. And we can actually go and kind of break that down further, and it's impairments. So you go to 2022, 2023, the impairments, and when they're in the unusual income and expense section here, they're not likely to keep recurring on an ongoing basis. So what you would do then is go back to your company reports and analyze and ask the question, what's this impairment charge and how long is it going to last? So if you can imagine now, let's say those impairment charges weren't there and you added that back into the profit section, actually there would be evidence of profit growth there. So and back to our analysis here, we can't give it a tick for income growth because there are impairment charges. But I do know now, and I will put down in my little research note here, do you know what? There's impairment charges at the moment, not likely to continue into the future. We need to monitor that. So I would give the likes of Alaska Airlines the benefit of the doubt in that regard. I won't give it a tick, but I would say it's not detrimental. If, on the other hand, these weren't exceptional items and everything like that, like what we said, if the net income down here was reducing as sales were growing and it wasn't due to exceptional items, I would have a problem with the company then in that situation. So next, what we're going to do is move on. In our next video, we're going to have a look at operating margins. So is the company keeping their operating margin stable? And that will be the next thing we look at for Alaska Airlines.